Welcome, everybody. This is the Origin QOZ Fund Update webinar. I'm Michael Episcope, co-CEO of Origin Investments, and today David Welk is joining me. He's our Origin's managing director, and he's been on several of these webinars. So welcome, David.
Thank you,
Today,
Michael.
we're going to go over the fund, seed deals, our pipeline, state of the market, and answer as many of your questions as we possibly can. The webinar is going to be around 1 hour in length, and Dave and I will spend probably 35 to 40 minutes on the presentation and then 20 minutes on the Q&A side. And we want to thank you for all the questions that were submitted in advance because they really help us tailor the presentation. So we're going to try to answer most of them throughout the presentation. But if you have other questions, please submit them to the Q&A box. I think everybody is familiar with Zoom by now. Don't put them in the chat box. Only in the Q&A box. We'll be going from there. Let's jump into the presentation right now, and I'm going to start by just talking about just basically the basics of QOZ investing for those of you who may not be as familiar. And again, this presentation is both for existing investors and prospective investors, so welcome to both of you. But we are going to go into just a little bit of this. This isn't going to be comprehensive. It would take us over an hour to be comprehensive in a QOZ law. So this is just another overview of the program. The way the program works is that capital gains from any source, stocks, bonds, real estate, crypto, no matter what the gains are from, and it includes both short and long-term capital gains. If those are invested into a QOZ fund, you will receive two benefits. The first is the tax deferral. So if you invest those capital gains within 180 days of realizing them, you will not have to recognize that gain until 2026, and that gain will be payable in 2027. So typically, if you had a gain in 2021 and you were going to pay it this year, you're getting an interest-free loan from the government for the next 4 to 5 years, and you can defer that until that period. The next benefit of the program is the most valuable benefit, and that's tax forgiveness. So if you are in the fund for 10 years and 1 day, you will not pay any gains on your gains. So if your investment grows from $500,000 to $3 million and you get out at 10 years and a day, you will pay zero taxes on that gain during that period. Little bit about the 180-day rule. You do have to invest within 180 days from the realization of the capital gain. And so if you have a sale from a stock at the end of last year, November, December, you're well within those 180 days. If you sold stock in your personal account at the beginning of last year, you're outside of those 180 days, and investing in a QOZ fund won't do you any good. Now, there's some nuance behind a partnership gain. And I think because most people don't actually know what their partnership gains are, so the IRS gave some very favorable rules around this. Number one, you can invest 180 days from the date that the gain is realized. But for the purpose of this webinar, I'm going to focus on one date, and that's really 180 days from the due date of the partnership tax return, which is 3/15. So any capital gains realized in 2021 from a partnership, you can invest those between 3/15 and 9/15 in a QOZ fund and receive the tax benefits of the program. Now, I do want to be clear that capital needs to be invested to receive the benefits. It can't just be committed. We get that question all the time, but it actually has to go into the fund within those 180 days. The QOZ fund, it's structured as an LLC, just like QOZ Fund 1 was. And I know that a lot of people, they don't love K1s, but you absolutely should be investing in a QOZ fund that has an LLC structure. This is really something important. And we had Ashley Tyson on in December, and he went over this in great detail. You get the benefit, the full benefit of depreciation and tax-free refinancing proceeds when you invest through an LLC in a QOZ program. You absolutely do not want to invest in a QOZ fund with a REIT structure. It will end up generating taxable income where there shouldn't be any. It's just the wrong structure for this program. If you have any questions about this, you can actually go to our website. You can download that webinar that we did in December with Ashley Tyson, and you will have all of your questions answered there. Investment strategy. So I'll just jump into this. We're developing apartments in transitioning neighborhoods and high growth cities across the Sun Belt. So what we typically look for are business-friendly states, business-friendly cities, low-tax states, and in high growth areas. So we're in the Southeast, we're in the Texas markets, we are in the Southwest. We cover about 14 markets today. And generally these cities have a population of around 1 million or more. So we stay away from the truly tertiary areas. And these are institutional markets. And so those are, if you look at all of our cities, Dallas and Austin and Nashville and Atlanta, I mean, these are all the places that you want to be over the next 10 years. And we as a company, we've always been investing in traditional, or what I'll say, not traditional, but traditionally investing in transitional neighborhoods. And it's really because we believe this is where the greatest opportunities lie. And it's certainly where we've had the most success as a company. And I do want to be clear that there aren't different underwriting standards for QOZ. The good QOZ sites are being sought after by all capital, not just QOZ capital. And when you look at some of the QOZ areas, and Dave's going to go, he actually is going to do some Google Earth, fly us around today to some of the sites. This is a little bit new, but many of the QOZ sites are really head scratchers, and they don't look anything like you would expect, like a low to moderate income area. And the reason is that the QOZ areas were defined based on the 2010 census, and many cities have changed dramatically in the last 10 years. And the next thing I'll talk about in terms of what we are really engaging in is a build to core type risk profile, right? And so build to core is when you develop a property from the ground up with the intention of holding it long term. And this fund is a minimum of 10 years, but could go 20, 30, even 40 years till the end of the program. We have some optionality built in that I'll get into at the end when I talk about the terms of the fund. Now, it takes about 3 years to lease and develop an asset, and then your remaining hold period will be in really a diversified portfolio of cash flowing properties. So keep that in mind in terms of a risk profile. It's not, you are going to be exposed to ground up development into the first 2 to 3 years. And it's our job to make sure that the properties are built on time and on budget. But then after that, your risk profile is really going to be in that stabilized cash flowing portfolio of Class A properties. Let's jump to the next slide, please. So a little bit more about the fund. These are some of the nuances about investing and some of the metrics behind the fund. But investors who come into the fund today will be acquiring units at $10, and you will immediately start receiving your preferred return of 7%. So that's the real advantage of investing sooner rather than waiting. And certainly you need to lock in your tax benefit as well within that 180-day window. So you will be earning that 7%. The advantage of waiting is that you get more information about the portfolio and the market. We launched this fund in October of last year. We've raised more than $130 million to date as we sit here today. And I know the slide says $113 million, but that is as of 12/31. So we are already 40 to 45% to our cap of $300 million in about 4 to 5 months. We get questions all the time, when are we going to hit our goal? And my best guess is in the next 6 to 15 months. It's really hard to predict capital raising. What we do know is that September 15th deadline is going to be a huge date, that it's usually starts ticking up about 1 to 2 months before that. And then the year end is also another big date as well. So best guess though, 6 to 15 months before this fund is actually topped off to that $300 million. I'll also say, like, fundraising in QOZ just has picked up substantially over the years. And in 2019, people didn't know what QOZ was. So there was a big education component on our part. And today it's largely been accepted as the best way to invest in real estate. Lastly, the fund is going to be diversified across geography. We'll have about 10 to 14 deals when fully invested. And the target return is a range we give between 2.25 and 2.5 multiple, and sort of that 10 to 12% net IRR to investors. And keep in mind that this does not factor in any of the tax benefits. So this is a pre-tax return, and is really also the equivalent of an after-tax return if you stay in for the full 10 years. And also, when you're in for 10 years, when you're looking at the IRR and the multiple, you have to look at them together, because over time, IRR is going to deteriorate. So if we're looking at these developments over a 3 to 5 year hold period, they're going to generate an IRR north of 16, 17, 18%. But the longer you hold an asset, the more the IRR decreases over time, but the higher the multiple on invested capital increases over time, or gets over time. And the multiple on capital is really a measurement of wealth building. So in this case, what it means is if you put $100,000 into the fund, that $100,000 will be worth about $250,000 in 10 years at the end of the fund life. Now, these are estimates. A lot can happen over the next 10 years, but I believe we're in the right locations and in the right markets. And if I'm painting sort of a bigger range here, I think our downside is a 1.9 to 2, and our upside here in this fund is north of a 3x return. Let me jump into the next slide. And this is really about why development. And the first reason are really supply and demand fundamentals. And there is a huge shortage of housing today. And I think anytime you open the paper, any of the news articles you're looking at talk about how rents are growing, how housing prices are going up. And what we have going on today is we have the millennials who are getting older and they're buying homes. And we also have a shortage in the market that can be traced back to 2008. There just haven't been enough spec homes that have been built over the last 12, 13 years, especially to satisfy the current demand. And in a typical market, we need to deliver around 300,000 housing units per year. But demand right now exceeds 500,000 per unit. So you have this supply demand, sort of this in equilibrium that's favoring developers and those who own properties right now. And that will balance out over time, but that will take some time before ground up development picks up the pace to satisfy that demand. And in terms of growth in the market, we've seen a substantial amount of rental growth over the last 2 years across really every market in the Sun Belt area. And we believe that growth is going to continue, but albeit at a much more muted pace. We're going to likely see rental growth rates fall back to their historical norms, 2, 3, maybe even 4 or 5% per year. The second reason why ground up development in this fund is we have to. It's by law. The program requires the developer or the sponsor to make substantial improvements to the property. And that's defined as doubling the purchase basis. So if you buy land or a property for $20 million, you have to put at least that much back into the property. And the only strategy that really meets that criteria is ground up construction. And that should make sense because the goal of the program when it was passed in 2017 is to create jobs. And buying an existing stabilized property doesn't do much to fit that criteria. The last thing though, development is where the greatest risk-adjusted returns lie today. And if you've seen our other webinars, we're not doing any core plus or value add. We're actually doing only preferred equity today. There won't be any of that in this fund, and development. And the reason why is because in the middle section, the value add and the core plus, they are now trading well above replacement costs. And we just don't think it's a great opportunity in today's market. So all of our strategy has really been geared towards ground up development. And in development, the goal is to capture the margin between the cost of developing a property and where newer properties are trading. So just to paint a picture, our goal is to build a 30% gross margin. And what that means is that if it costs us $265,000 per unit to build, and that's roughly about the cost, depending on the market, it can be, plus or minus 40,000 around there. we want the property to be worth more than $345,000 per door when stabilized. So the way we analyze and we view the world is that we are looking at what properties are trading for today and then comparing those against what we can build. And mind you, like, we won't be delivering for 2 to 3 years, but we're not trying to anticipate what properties will trade for in 2 to 3 years. We're actually building based on that margin is based on what it looks like today. So we're locking in our costs, and certainly if there's more appreciation, then we can do even better than 30% on our margins. But I should note that the margin is penciling out in all of our markets today using somewhere between realistic and conservative underwriting variables. And even when you factor in the increase in construction prices, the 20%, the 25 to 30% that's happened, rents have outpaced that by a substantial margin, which has kept the development margin in check. And so, like, in our markets, we're still looking at realistic and reasonable growth over the next couple of years, and we're locking in contracts under a guaranteed maximum price so that we can reduce our risk as much as possible during the construction phase. And I should also mention that we use between 65% and 70% leverage in this fund. And we measure that as a loan to cost for when we're in construction, and then loan to value once the asset is stabilized and we refinance. Let me jump into the next slide. So a question always comes up about how much cash flow is going to come back. People have to pay their taxes in 2026 and 2027. And as we develop and stabilize properties, we will be returning cash flow to investors. And in this fund, we anticipate being able to return 30% or more of invested capital by the time your taxes are due in 2026 and 2027. Our goal is to return more than that. We're trying to set realistic expectations, understand I'm in this fund, my partner Dave is in this fund, we have a tax liability as well. We're aligned, and we want to return as much capital to you as possible, to both so we can satisfy our tax liability and to pay down the preferred return over that period as well. Now, after the portfolio is stabilized and we get through the refinancing, you will receive regular quarterly distributions from operational cash flow, and all of that will be shielded by depreciation. And one nuance I want to make you aware of here is that by law, we can't return any capital within 2 years from the last investor coming into the fund. So if you happen to be a Fund I investor as well, the last investor was let into the fund last year in September. So you won't see any cash flow in that fund until 2 years after, because under IRS rules, if we return capital within 2 years from that last investor coming in, it's considered what they call an inclusion event, and it will be taxable. It's really looked at as all we're doing is giving you your money back. So that's a little bit nuanced. But really what we believe is the last investors, they're going to be admitted the earlier of $300 million or the end of 2023. And we firmly believe that $300 million cap is going to be hit sooner. So distributions will likely commence in 2025 and accelerate thereafter. Let me jump to the next slide, which is our seed assets. And I'm going to briefly talk about this and just make, kind of one point here before I hand it off to Dave. And if you look at this chart, number one, you notice that we have quite a bit of diversification, but we already have $180 million of required equity for our seed assets. And our team has been out looking for deals for the last 2-3 years, and all of our activities in Fund I have really benefited investors in Fund II. And you can see, our pipeline is incredibly robust right now. And these are deals that are under contract, they're in due diligence, and it doesn't even include our pipeline of deals, which are in various stages that we're trying to secure right now. And Dave's going to talk about those a little bit more. So investing the $300 million into the right projects will not be an issue at all. So Dave, I'm going to hand it over to you now to talk about the seed assets, go over the map a little bit. And Dave is joining us. Actually, he's in Nashville today, so in a remote location. And then he's going to talk about the pipeline and state of the markets and hand it back to me, and I'll talk about the terms of the funds. Dave, over to you.
Awesome. Thank you, Michael. Good to be with you all. As Michael mentioned, from Nashville this morning. You can tell by my white hair, I am technically not a millennial by the definition of it. So my technology skills are being fully taxed and challenged at the moment, doing this from a laptop. And as Michael mentioned, we'll be flying around. This all works virtually on Google Earth and showing you all the sites and locations that we've identified in our seed asset slide that Michael has discussed. And as we know, location matters. And what we'll do is we'll start with what we believe to honestly be one of the best located OZ sites. I think that this is a great representation of the country in terms of the diversification that Michael mentioned. That we've already seen the fund with. So as you can see, we've got pinpricks in the map in multiple high growth destinations throughout the country. We're going to start where I'm sitting literally right outside my window here in Nashville. We'll talk about that site I just referenced. Then we'll bounce down to Florida, and we'll talk about a project that we just moved forward with down in suburban Tampa. Then we'll jump over we'll head west to the mountains, and we'll jump into Colorado Springs. And we have a lot of experience in the downtown Springs. For those of you who are investors in Fund One, you're quite familiar with the two large assets that we have there. Excited to be breaking ground on our third opportunity with our development partner, Greystar, here later this year. We'll jump into Arizona, talk about one of the most explosive growth markets in the entire country, in Phoenix, and then we'll jump back to a project that's near and dear to my heart here in Atlanta, not far from here in Atlanta, that we are about to close in 2 weeks on a 40-acre parcel that is pretty dynamic, multi-phased in structure. So without further ado, we will fly into Nashville. So I mentioned before why this site is so compelling and why we're so excited about it. And I don't think there's a better way to tell the story than honestly this visual. And as Michael mentioned in his opening remarks, a lot of Nashville is no stranger to the commentary that he made, which is when the OZ designation was put forth, it was based on the 2010 census data. And Nashville, like many of our other Sunbelt markets, has seen dramatic growth in and around the opportunity zones that exist. So this site, and I can show you graphically exactly where I'm calling in from today, but I am literally in this office building right over here. Right here. So our site here overlooks a bluff from I-40 and I-65. So anyone who's approaching Nashville from the airport, this will be one of the most visible points that you see, because again, we're set up on a little bit of elevation. I'm coming to you from the Gulch here, which is known as this area because it sits a little bit more recessed from downtown Nashville. But we'll have some of the most prominent views into the skyline of any apartment community. And there's already, as you've seen over here in the Music Row area, there's a significant amount of development that's already occurred here naturally, again, prior to the OZ designation. We are very excited about this project. This will be a multi-phased opportunity for us. We're planning to do 730 units on this site, trying to figure out exactly the sequencing of that, if we're going to build them together or if we spread them out in a couple different phases. But this is going to be a hallmark project certainly for us, for our fund investors here, but also within the city of Nashville. So very excited about this opportunity to partner with Marquette, and to mention them too for a second. For those of you who invested in Fund One, we partner with Marquette on an OZ project in Houston that has gone incredibly well. We're exceeding our underwritten rents on that particular asset, and we're very excited to be partnering with them again on this a very compelling opportunity. There will be potentially some additional uses on the site. We're trying to figure out exactly how we would participate, if we would participate in any sort of non-residential uses there. But there's already been discussions with some potential grocers who are looking at the site. There's potential for some office use here that we likely will not fully participate in, but there is interest from potential office tenants here because of the site is so dynamic and the views, excuse me, are so incredible. There will be a mix of uses that likely will be programmed here, but again, we'll figure that out as we put together the site plan overall for phase one. I'll share with you 1 second here. I think I can show you the aerial, but as you're now looking into downtown, this is what the overall site plan that we've conceived of with our partner looks like initially, with a public park in the middle, and then the surrounding uses around. So as you can see, the views will be everything I mentioned in terms of compelling, and will achieve some of the highest rents we think as a result of the submarket. So we will jump out now into, we'll head to Florida. So we are heading now down, so from the urbanist of urban locations to a definitely suburban location here in suburban Tampa, in Wesley Chapel. So I'm going to zoom out because I'm assuming a lot of folks don't really know where Wesley Chapel's at, probably are unfamiliar with some of the outlying locations here in the metro. Tampa has become, is one of the fastest growing Sunbelt markets that we invest in. There's a lot of desirability aspects to live in Tampa. In some respects, we were a little bit curious as to why Orlando has seen so much investment in development activity over the last few years. We like Orlando. We have a growing presence there. We are committed to it, and the numbers speak for themselves. But Tampa, it is difficult to argue with the beaches that they have here, the pro sports teams that they have, the size, the office market, the access to education, which is not too dissimilar from Orlando. And so we've been investing or looking to put some stakes on the ground in Tampa. And Kyle Verhassel here in Nashville has been all over this market looking for opportunities for us. And what we've seen in the last 12 to 18 months is a huge uptick in terms of development activity. Rent growth has been explosive here. The only other markets that frankly rivaled Tampa in the country in the last 2 years have been Jacksonville, which Kyle's also put us into a project there as well, and then Phoenix, which we'll cover in a second. But the growth in Tampa has been explosive. So our particular site sits here in the northeast of downtown. It's about a 30-minute drive to downtown Tampa. This is in a master planned community called Two Rivers Ranch. And Two Rivers Ranch total is a 3,400 acre master plan. And there's going to be over 6,000 residential units programmed for this site. I'll see if I can drop in the overall master plan itself, but this gives you kind of an idea of when this is fully built out, this 3,400 acre plan, what this will look like. So there is a huge, we look for catalytic and dynamic patients. And while you might say, I mean, the Gulch opportunity is kind of a no-brainer in terms of what's going around it in urban Nashville. This is about as catalytic as we're seeing in the suburbs. So there is a lot of activity that will be happening here. There's going to be 80 acres of parks and schools, 1 million square feet of office in here, some designated industrial uses, 630,000 feet of retail. I mean, this is a catalytic project to its core, and this entire master plan is located within the opportunity zone. So we are very excited. This will be our first partnership with Minneapolis-based Roars. Although they have a development professional who's moving to the Tampa market here and will be overseeing the project in our partnership. But there's already interest from the residential developer community, the home building community. There's 100 million in lot sales that are under contract right now, with 20 million of hard deposits on lots. And it is definitely a bit of a who's who list of developers here. We've got West Bay, D.R. Horton, Toll Brothers, Pulte, Lennar. I mean, and when you think about building out 6,000 units here, you're certainly have a strong interest from a who's who list of national builders. And the home prices here, when you think about valuations here, you know, what's the for sale market look like? What's our development basis look like? The projected range for sales here for homes is between $600,000 and $800,000. So that shows you that obviously there's an affordability component to the folks that are going to be moving here. And that's one of the things that we look at very strategically is, as we mentioned, how do the OZs, how are they designated in the first place? Well, it's actually based on incomes of the census tract. And we are looking for those locations that have seen that growth, and we can demonstrate it by the around stock in terms of who's moving there. So this is another great example of certainly this tract it was low density in 2000, and we'll look at some of the growth around it. But it has seen a huge influx of new development, and will continue to do so through this master plan. So some of the attributes here locally, we do actually have pretty good access to retail. There's the shops at Wiregrass are off of Highway 56 over here, so it's about 2 miles from the project, and this is where daily life will lead, to the extent that we're waiting for the build out of the 600,000 feet of retail in our community. That's not all going to come at once, but there is existing infrastructure here in terms of restaurant, shops. There's about 600,000 square feet total in this little node, so there's plenty of retail to service this community once it gets offline. We're about a 10-minute ride to a number of employers, including at Zephyr Hills, Florida Medical. So you've got a lot of medical concentration here within the submarket. A number of corporate users up and down I-75, which is about 7 miles from our project here. It takes you right into the heart of downtown Tampa. And along there, you have a number of, again, office nodes and employment drivers. So 30 minutes from downtown, self-contained community here, with 6,300 different homes that are planned over a period of time, 3,200 acres. So we're excited about this one, and excited to benefit from the demand drivers around us.
And now we'll transition, as I mentioned previously, over to the mountain region, and we're going to head over to our third in a series of opportunities in downtown Colorado Springs, our newest venture opportunity with Greystar, Elon Rio Grande. And we have become increasingly the largest and most active developer in downtown Colorado Springs, really in the last 2 years, and driven by some of what we viewed as the most interesting and compelling QOZ opportunities that we've seen, again, in the marketplace. And the thing that we really like about downtown Colorado Springs is it's really become a low-cost provider option to folks living in Denver. And if you weren't quite sure, don't quite understand the dynamics and locational differences between Colorado Springs and the Denver metro, we'll zoom out here for a second and kind of show you the proximity to the south suburban region within Denver that folks can commute to. But down the I-25 corridor, depending on where you're driving from, which part of Colorado Springs you live, the Lakewood, southeastern suburban office nodes and demand drivers are anywhere, depending on traffic, 25 to, if you're in North Springs, kind of downtown where we're at, it's about 40 minutes. So not a significant commute. Some folks are definitely doing that. And the thing that we like about the Springs is that you have this mountain lifestyle that people crave in Denver, but it comes at certainly a much more affordable price point. So you have your own demand drivers here within the Springs itself. The Air Force Academy here has a large presence, so there's a large military presence. Here's the airfield over here to the east. But you have a number of government contractors in here. You've got the presence of NORAD over here in the Pikes Peak mountainous region to the west. But then you have a growing submarket here in downtown, which has become a very desirable urban node. You have a number of bars and restaurants that have popped up here in downtown that are walkable to this project, Elon Rio Grande, and I've put some pins in the map of where our other two assets are located. So literally within a few block walk in both directions of where we are under construction on Fiona. We will be on Weber Street as well, and then we will have some real operational scale that we'll be able to draw from. And again, these two assets are being built on behalf of Fund I. So in Fund II, we will benefit from some of that operational scale as these projects come online. And it's much more efficient when you have a large scale of units in a defined geographic location. You're getting what I continue to reference as, again, scale. Operational scale just means that there's a number of fixed costs when you operate in a multifamily community. Some of those are variable, but certainly payroll is one of those things that as you have more units, it's more efficient for you to operate something with a fixed number of people. So we will benefit from the work that's done here in Fund I and the assets that we own in downtown Colorado Springs on behalf of Elon Rio Grande. But as I was mentioning before, again, there's a real walkable aspect here to the site itself. You'll have downtown in terms of music venues, entertainment venues, restaurants and bars, really up and down this corridor here. As you head north into downtown from the site, you've got really great access to a hugely desirable amenity base. You've got a number of parks that you have access to, which again really feeds into the outdoor, mountainous lifestyle that folks are craving here in the region. So in terms of, you have this walkable aspect to this specific location in the Springs. What it does in terms of, or how it performs on relative affordability to urban markets of Denver, and you're really competing against a few different nodes within Denver. You have infill Denver proper, which has a number of neighborhoods that are, have varying degrees of walkability and desirability. And then you're also competing against some of the urban suburban nodes. I mentioned the Southeast suburban submarket previously. The tech center has a lot of walkable elements to it, but what the spread differential in terms of the affordability here in the Springs provides is in some cases upwards of $400 to $500 a unit discount to live here in the Springs. So that is meaningful. Their rents here are actually quite high as well on a relative basis. So rents in this market are $240, $250, $260 a foot, depending on the product. That's comparable with the urban locations, a lot of our markets elsewhere in the Sun Belt. However, those same rents in urban Denver might be, again, $3 a foot or approaching it. So definitely a discount to live here in the Springs, but enjoying, again, a lot of that lifestyle and access to the mountains that folks in Denver love. So we're excited about this project. And I should note too that similar to both Fiona and Ensley, we will be benefiting from what we view as one of the most compelling reasons to be outside of the quality of life, affordability aspects we just covered, and the demand you're pulling from Denver. But one of the biggest benefits to owning and developing, especially in an opportunity zone or whole period, is downtown has been designated, the entire downtown area has been designated to receive TIF funding. So TIF is basically the way it's structured is we will receive a 65% reduction on our tax bill for a 15-year period. And that is exceptionally unique. In fact, I don't believe we have any other projects in the portfolio that also benefit from the federal tax benefits from the OZ legislation, but also the property tax itself receives 65% reduction. And so the uniqueness again of the OZ hold period is that there's a strong possibility, as Michael mentioned, that this fund life could extend well beyond the 15-year period. And that's exceptionally rare. Usually, and we've done a number of deals in the past where they have a TIF element to it. Sometimes it's 10 years. 10 years is more typical. We've had 20 before. But what's more normal is, you'll hold for 5 years and then you'll sell to an investor who will enjoy the next 5 and then so on and so forth. Here we'll get to see the full benefit of the TIF. So hugely improves the overall deal economics relative to projects that don't enjoy that as well. So from here, we're going to hop out to, we're going to head down to Phoenix. So we're going to head over to the Solace of Ballpark North, which is located in West suburban Phoenix. And as I mentioned previously, Phoenix itself, and we'll pull out here for a second to kind of cover just general location within the Phoenix metro. But Phoenix has been one of the fastest growing markets in the country. It's really been a beneficiary of the outmigration from Southern California. I've heard stats, I don't know if I can fully quantify this as validated by third party, but that 1,000 people a day are moving out of Southern California to Phoenix. I'm sure that we can back check that and corroborate it, but it's evident in the demand that exists for the existing inventory and housing stock in Phoenix. It's produced the highest rent growth of any market in the country in the last year. So depending on the sub-market you're looking at, and we're active in a number of different sub-markets throughout the Phoenix metro, but upwards of mid to high 20% rent growth year over year last year. So huge demand coming not only just from California, but frankly from all over the country. That is, Phoenix, one of the benefits of it is it's still relatively affordable. So when you compare the cost of housing, whether it's to purchase a home or to rent an apartment relative to certainly the California markets, it's a bargain. So we believe that there's still more rent growth to be achieved here in the Phoenix metro, specifically to this asset. And we've looked at a number of projects on this I-10 West corridor over time. And this is some pretty fertile OZ ground over here. And in terms of again, we talked about it with the nature of Edge Hill. This was farmland 10 years ago. Phoenix has seen dramatic growth west and east and a little bit south, but certainly most of this has been west. And along this I-10 corridor, a lot of that growth has existed because frankly, this is the primary thoroughfare into Southern California. So a lot of goods are transferred on this I-10, connecting the two major regional metros. So this has been, I-10 West has really benefited from industrial development, but more recently, you've seen a number of other demand drivers that have come into the market. The Cleveland Indians and the Cincinnati Reds moved out of the Citrus League in 2009, and the city of Goodyear at the time built a large ballpark facility here. So that's hence the property's name, Solace at Ballpark. So you can see the Reds training camp facility here. This is where Cleveland plays. Here's where the property's located. So if any of you are baseball fans, in particular of those Ohio teams, you'll have great proximity to catch a spring game and go visit the property if you're out in the marketplace. But what this development has done in terms of the overall training complexes themselves has really kind of spurred a host of new development And as you can see, large tracts of homes have been laid here in and around this in the site that we have under control. So a lot of growth here, as I mentioned. The stadiums themselves are 10,000 seat, so they have a fair bit of capacity. It's bringing a lot of activity to the area. Certainly, folks are coming down, to escape the harsh Ohio winters, but it's definitely a driver for a good year. And I'll show a quick image, if I can do this correctly, of the renderings of the project itself. So I think that bears some sharing. So the project itself will be 3 and 4 story buildings totaling about 296 units upon completion. It's going to be a gated community. We'll have typical Class A amenities here that we're delivering in most of our projects. So high-end fitness center, pool, open space, dog parks, child playgrounds, and the like. So from a timeline perspective, we will be working through the pre-application process here and hoping to break ground later this year, but excited about this project upon its completion. And of note here, the demographics that we mentioned have changed substantially here in Goodyear over the last 10 years. So this site would absolutely not be qualified as an OZ once the new census data comes out in 2020. And that's a pretty consistent theme with, frankly, most of the deals that we're pursuing. We're getting the benefit of prior gentrification, and these markets right now, these would command, these locations, certainly here in Goodyear, and the rents that we're underwriting to achieve would attract non-OZ market rent or market rate growth. So we will jump to the last site here in Atlanta, which is a project near and dear to my heart, because I've spent the better part with our partner, and we'll talk about them in a second. But we've spent a lot of time in the last really 120 days or so putting this project together. And what is unique about this, and we covered previously the Nashville project, this is a multi-phase site, certainly from at its core, and given its size is why we will be ended up breaking this apart into multiple different deals. But for those of you who aren't familiar with the city of Atlanta, it probably is important to spend just a little bit of time talking about the location as it relates to downtown and some of the other probably more familiar submarkets of Midtown. Folks have heard of Buckhead. Atlanta's kind of shaped, they call it the Atlanta martini glass. So 75, 85, 285 is the top of the glass, and here's the stem, 75, 85 that takes you up through Atlanta. So a lot of folks are, the old adage used to be you invest inside the martini glass, really, which is kind of Buckhead, Sandy Springs, Brookhaven, and then up and down the spine here in Midtown. Downtown historically has really for the last 30 or 40 years has not been a place that has been attracting a lot of capital. A lot of the investment that existed in downtown, or a lot of the companies that were in downtown in the late 70s and early 80s kind of bolted up to Midtown. And so a lot of the growth has kind of passed through downtown and has been pushing historically into east of 20. In some cases, a lot of it has been north. And what the newest phenomenon in terms of development and gentrification in Atlanta has been the areas that are south of 20 here. And these areas have seen the most rapid change in population and demographics in the entire region. And a huge part of this is because of this stretch right here. This is known as Atlanta's Beltline. So the Beltline effect, and has been largely studied and has had dramatic success for any developments that exist along the Beltline in terms of their ability to attract new tenants if they're an office building, or achieve outsized rent growth. Again, it's been widely studied and documented that there is a Beltline effect that creates value. And the Beltline story here is what's important to understand about this site in particular. So we are within the half-mile ring, which that's, if you look at the statistical analysis on where do you see, plus or minus the Beltline effect start to lose some of its effect. And we're right around the half-mile from our closest point to the Beltline here. So we check from a statistical standpoint. What's important to note is that Chosewood Park, which is located across the street, and that's the area of Atlanta that this site is located in, it's called Chosewood Park. There is discussion and some funding, and we will be working on getting the balance of the funding to create what's known as a spur through the park and back basically to our front door. And there's a lot of spurs that exist on the Beltline Trail currently. There's more planned on the West Side Trail, but that would be an absolute, I mean, we're already benefiting from Beltline proximity here, but bringing it to our front door would create this, would basically serve as beachfront real estate at that point. This is a very unique site. You can see how large it is. It's a 40-acre concrete plate. This is a former GM facility, production and manufacturing facility. So we've spent a lot of time over the last 90 days really studying the soil conditions underneath the concrete slab, pricing out the cost of demolition of the concrete itself. But the plan here over many years is develop upwards of 1,600 units across multiple different phases. And what we're attempting to do is preserve some of these buildings themselves actually are quite impressive. They're actually used by Netflix and currently for prop storage and active filming for a number of their shows. So this was built by GM, again, part of their production facility, originally constructed in the 60s, but this is 24 to 26 foot clear heights, old steel building, beautiful inside. The old adage of they don't make them like this anymore is absolutely true. You would never recreate this building today. So we're trying to preserve some of this building and actually get quite creative with it. And we will be converting portions of this building into our common area amenities. So we'll create a fitness center and a pool and club and lounge space in here across multiple stories that will serve as the central village center for the entire project when it's fully built out. So what we're contemplating for the initial phase here would be some townhomes on the back portion of this property, creating some public open space here, which would serve as kind of the village center, and then a 250 to 300 unit wrap project and another 250 unit, 300 unit surface parked project here. So that will be the initial phasing that we're contemplating for the project itself. And I'll share with you overall site plan here itself. So this is how we're envisioning the site breaking up over time into these different quote unquote blocks, which will support different types of development as the project comes together. So very, very cool project. One that is definitely a passion project for us, but it gives us a lot of flexibility and optionality in terms of delivery of units to the market. If we all of a sudden are seeing that the construction pricing is actually going down, and we can kind of the fundamentals are continuing to remain strong, then we can press forward and deliver additional phases as the market warrants. So certainly more to come on this. This will be likely end up being about 3 different investments, separate investments inside the fund itself. But we're looking to close on the land really in the next 2 weeks. So that kind of rounds out our virtual tour of the markets. Happy to spend more time with folks as needed as these projects come together. But in the end, as you can see, we've created a nice geographic diversification throughout the country. We have pipeline deals too that will add to this. We've got another project in Charlotte that we're looking at. We eventually potentially could have exposure to our phase one NOTA project over time here in Charlotte as well. We've got a few deals in Texas that we're close on. So we believe that we'll achieve the desired geographic diversification that we achieved in Fund One. And we have some pretty compelling catalytic multi-phase projects to execute on that we currently control. Michael, back to you.
So these are the summary of terms, and this is really the same as QOZ 1. So that's a question, how is this going to be different? We've certainly tempered return expectations from Fund 1 to Fund 2. I think in Fund 1, our return projections were somewhere around 2.5 to 2.75. This is 2.25 to 2.5. So, the lower range of Fund 1 is sort of the upper range of Fund 2. But the terms are, there's a 1.25% annual asset management fee charged to investors. There's a 50 basis point acquisition fee, and then there's a 15% performance fee subject to a 7% preferred return and a $50,000 minimum investment in the fund itself. The fund is audited, and our fund administrator is SS&C. That's also who we use on the Income Plus Fund, and that's who we use on QOZ Fund 1 as well. And the fund is designed to have optionality to let people stay in longer. So many of our investors want to be in for 10 years and a day, and the fund will be marked to market at all points throughout the life of the fund. And when people want to get out, we will sell enough assets to get them out. If you want to stay in for another year, 2 years, 5 years, or to the end of the program, you have the optionality to do that. And the reason why we did that is because what we're finding is there's really three types of investors: those who want to get out 10 years in a day, those who know they want to stay in until the end of the program, and those who aren't sure. So we built in some optionality into the program that is, I think is beneficial to investors.
What I will do is I'll jump into state of the market, and there's a lot we can cover here in terms of each one of these bullet points, but interest rates seems to be one of the most important topics on folks' mind right now, given the pending rate hikes from the Fed. We believe we don't have a defined, established house view in terms of how we view where the Fed's going to move over the coming quarters. But we do believe that some hike is imminent. And frankly, I think it's probably a good thing, because one of the other bullet points on here is construction pricing. And that has a tie-in to general inflation, which we've seen general inflation running incredibly hot. And that has impacted construction pricing, but that's impacted rents. That's part of that soup and inflation. And now, 7 to 7.5 on more recent readings on core inflation. That's not sustainable. And nor is the rise in rates or rents. And we're not underwriting that, certainly. So we do believe collectively that rates will go up, that the Fed will be taking action, and that it's necessary. So what does that mean for us? How do we underwrite? How does that impact our decision making? As we've always done, we've taken the forward curves that are widely established and traded, and we are taking those forward curves and loading those into the model. And I will say that anything that we've underwritten a year ago had a much different outlook in terms of the rise in the forward LIBOR curve. Or in some cases, we underwrote, the forward treasury curve on a refinance. So in real time, we've been updating this, and now the market's suggesting that the LIBOR or SOFR, the replacement, is heading towards low to mid twos in the not too distant future. And if you look at old curves, that was certainly way out 10 years down the road. So we are modeling the best reality that we can find in terms of the market segment. But more important to that, we're taking proactive measures in terms of instituting some various interest rate hedging programs. We can get into details, more specifically. This is something that Mark Turner, my counterpart in investment management, Dave Shearer, Michael, and others are helping us execute. But we're taking a very proactive approach to future rate hikes and future increases in interest rates. And that's a multi-pronged strategy, but simply put, it's a consolidation or consortium of using long-term fixed rate debt, which there's a few different ways that you can implement that. You can hedge it immediately with a HUD loan. That takes a little bit of time to put together, but it's an interesting instrument. We have some HUD loans in our portfolio. It's a 40-year fixed rate interest rate at right now is in the sub 3% range. So we will be looking to execute on some of that. Much more quick and easy to execute is fixed rate loans, and those are available from a consortium of lenders, life companies, and the agencies. So there'll be some of that, and then more interesting to talk about certainly is some of the other strategies that we've implemented, which is using swaptions and swaps themselves to swap out a fixed rate component, giving ourselves some flexibility to refi some of our assets. As Michael mentioned, we will be refinancing some of these properties throughout the hold so that we can then in turn return cash to pay tax liabilities. So we need to maintain some flexibility in our liquidity. And then some of that strategy admittedly is to remain some of the portfolio unhedged because we don't know where rates are going. And there is a chance, albeit we feel small, that rates maybe could compress or stay the same. And thereby you would be better off not paying the increased cost to fix your interest rate. So that's a longer than I'd hoped on interest rate. I know we're getting towards the end and we still are trying to get to questions. I'll just cover construction pricing quickly. If you've joined any of our other webinars, more recently, you've heard some of the anecdotes that are happening in the marketplace. We're seeing, uncharacteristically and unprecedented increases month over month in construction pricing. And it used to be lumber that was, all that anyone talked about in the marketplace. That was kind of a 2021 thing, early 21. And as we went throughout the course of the year, it wasn't just lumber, because what was happening in the marketplace is a lot of the suppliers and subcontractors on a project saw the quickly rising rates in lumber and the fact there was still development activity occurring. And there was a lot of, I'd like to get some of that too. That was happening in the marketplace. And that continues to happen. But in addition to that, we're seeing supply chain disruptions continue to be real. Availability and ordering of appliances has now never been longer or more challenging to procure. The timelines to order your roof materials is a year out. There's a general run on commodities right now. So long way of saying, Michael answered this earlier, but said, rent growth has outstripped the pace of construction price increases, which has, really helped maintain margins. I hate to hypothesize where I think construction pricing is going to level off in terms of its rate of increase, but we do believe that there'll be some moderation as the supply chain issues do get worked out. That could be a year though. I don't believe that we're going to see 0.5% to 1% month over month increases in the pricing market in perpetuity. There will be some leveling, and it will create some deals won't work. High-rise construction, which already has tighter margins, as that becomes more costly, land bases continue to go up. We might start to see some projects getting shelved as a result. I'll finish with growth rates. We take a very disciplined approach in terms of our underwriting of rental rate growth. We have a proprietary machine learning model that we've developed. It works in concert with our folks that are in the marketplace, and we use it when we underwrite every single opportunity as an unbiased way of underwriting where we believe rents are going in the marketplace based on the inputs of about 3 to 4 billion pieces of data that we process. So the long and the short of it is we forecasted early some of the growth that occurred in 21, which is why we were ramping up our activity in markets like I mentioned in Tampa and Phoenix and others, because we called that early before it was fully recognized in the marketplace. We believe rent growth to continue for next year. It's not going to run at 20 to 27%, which is where Tampa and Phoenix ran last year, but we think it's going to be still very robust and certainly above historical averages in the 6 to 7% range in our target markets. From there, we believe there will be some leveling off because supply will continue to occur in these markets because of all the things we talked about, is that growth is still outstripping the pace of cost increases. So we have a very bullish view internally for 22, and then 23 we see probably more of a return to normal and maybe a little bit of stagnant growth from there on out. So that's as far as our crystal ball goes right now. But Michael, back to you and any questions that we need to cover.
Great. Let's jump into that. So Dave, we'll go over some of the questions here that weren't answered, or we can just maybe answer them in a little bit more depth. Here's one for you. Please compare risk reward in new development of Class A versus Class B multifamily during economic down cycles.
Yeah, it's a great question. And we actually have pivoted our strategy to address this particular question. And if you look at where valuations have gone or where they could go and when they've gone in the past, I think there's need to look no further than what happened coming out of the GFC. And we were the beneficiary of coming in early to buy. And I was responsible for some of the acquisitions in Atlanta. And Michael, you were there. It was $14,000 a door. We were buying Class C 1960s vintage apartment buildings, which is unheard of. I mean, that is a third of land pricing in the cheapest land deals we could see right now in the market. So what you see is a high standard deviation in those assets in terms of its fluctuation in value. And largely that's due to the underlying renter base. And that renter, as many renters have become taxed in terms of their ability to pay rent. And that renter is more elastic at the end of the day in terms of their sensitivity. There's less wallet share that they have to pay rent. And a lot of those folks have been completely taxed too. The rental rate growth in the Class BC workforce housing segment has kept pace with Class A. But what that's done is that's eaten more into their ability to live the lifestyle in a way that the Class A renter has certainly more discretionary disposable income. So I will say this, we've seen rents plummet more dramatically in times of distress and in downturns. For the reasons I mentioned. Yes, they are more sticky as a renter, certainly, but we've also seen that in times of distress, collection of those rents is never what anyone underwrites. And we were right there with the rest of the market where we underwrote 90% effectively economic occupancy. And we had months where we had 20 to 22% bad debt. We just couldn't get people to pay the rent. So a lot more volatility on the pricing, a lot more volatility on the operations. We're very have a lot of faith and belief that we're in the right segment of the marketplace with the Class A renter, and we're straddling that affordability piece that meets the widest range of the marketplace. That's kind of the $1,300 to $1,800 rent price point.
Dave, I'm going to follow up this question. I'm going to ask this of you, and just for our listeners today, understand that Dave comes from REEF, which is an institutional or real estate organization formerly out of Deutsche Bank. And Dave is really responsible for a lot of our institutional standards that we brought into our underwriting, our risk management practices, and it is collective, but give him a lot of credit for this. So here's the question. How do you plan for possible downturn of the real estate market in a year or two?
Yeah, and I guess this goes a little bit hand in hand with the forecast that I just laid out there, where we believe there's going to be some robust growth here in 22, 23 and beyond is a little bit hazier. So the way we prepare is a lot of the things that we mentioned before, right? It gets back to our interest rate hedging program. So we are preparing for, we're trying to remove some aspect of the risk in the business plan by fixing those rates. And then we can focus on the operational aspects of the asset and the development phase on the execution of it. So we're definitely planning in that regard in terms of preparing for a downturn. But I would say even more globally, more holistically, we prepared ourselves in a way to outperform both in good markets and in bad markets our peer set, because we've selected the right places to invest, and that comes with years and years of study and experience in the marketplace. And now we have an AI platform that corroborates our long-standing investment thesis and belief that these are the highest growth markets. So while we can't fully insulate in future downturns, what we can do is prepare ourselves in the best possible way to win. And that is by investing in these high growth markets, by investing in the highest margin assets, by investing in the segment of the renter class that has the largest wallet share as a percentage of their income. So I'd say that we're doing all these things to defensively prepare ourselves for a downturn, but no one's immune to it. But we think we'll weather the storm better than most.
Yeah, and Dave, I'm going to add to that. If you could maybe grab a question or two from the Q&A, and when I'm done with these, you can answer those. So we're coming up on time, but we'll go over about 6 or 7 minutes today. The other way that you do it is by putting a lot of equity into a deal, and we do that. And so our deals are typically 65 to 70%. In this fund, we are not using preferred equity. We're not going higher than that. And when you think about a development deal that's leveraged, I'll just use the high end at 70%. If you have a 30% margin, when that deal is stabilized and done, you're at about 55% of value. And then what we do is we go out and refinance, and we'll be at around 65 to 70%. So 30% of equity in an institutional asset is significant. And so that's one of the ways that you really mitigate risk. The other way, we don't guarantee loans. So there's none of that within this fund. I would be very careful and skeptical about funds that do guarantee loans, because what happens is it becomes a little bit of a house of cards. And we saw this in 08 and 09, because chances are if one deal is going south, a lot of deals are going south. So it's important to have all of your assets in special purpose entities that are isolated from one another. And then lastly is geographic diversification. The fact that we have sort of a national view, we're in the Sunbelt markets, we're in these institutional markets. Markets behave differently, and you might have an overall recession, but it could be that Houston, which has been a non-correlated market the last few years, as things have been running up in these other markets in Phoenix and Austin and Tampa, Houston has largely been left behind except from this last year. But now you see oil running up. So there's a chance that we get energy prices, inflation that causes some disruption, but then our Houston assets do very, very well in that environment. And, something like Denver is going to behave differently than something in, than deals in Charlotte. And so I think having that geographic diversification helps immensely to mitigate risk. The other thing I want to answer, we get a lot of questions about 1031 exchanges. This is what I would call a substitute for a 1031 exchange. And the advantage here is that when you have a gain, you only have to invest that gain. So with a 1031 exchange, you actually have to invest all of the capital, right? Not just the gain. You have to invest your basis as well. So I would say that if you have a 1031 exchange and you can't find a replacement, some people actually think this is better than a 1031 exchange, but I would just tell you that it's maybe a close second, in my opinion. So, but you don't want to run out into real estate finding that 1031 exchange, overpaying by 5 or 10% to a piece of real estate. So I would strongly, urge you to consider this and look at all the details and evaluate the two amongst each other, because we certainly have individuals who have foregone a true 1031 exchange and invested their gains into the QOZ funds to get those benefits. So Dave, I'm going to jump over to you now. So any questions you want to tee up?
Yeah, I'm assuming you can see me because I've got the Q&A box open on my phone, and there's only
I can see
one. So I'll take a couple of quick ones that I can knock out. So the question was Edge Hill part of Fund I? The answer to that is yes. It is a large project. It's multi-phase, as we mentioned before. And we really strive for diversification that Michael mentioned. So we are not looking to over allocate the fund's exposure to any one deal. And I mentioned how dynamic that location is. we're excited that Fund One has exposure. So the answer shortly is yes. Ed Shell is part of Fund One, and we'll have exposure in Fund Two as well. So the other question was list of finalized deals in the pipeline for Fund Two. We won't be providing a detailed list per se, but we did provide the seed asset slide and covered each one in detail. And as obviously the fund makes investments, and it has in some cases, we've closed on the land for Nashville. We're closing on the Sawtell site here shortly. We will prepare a list of investments, and that'll be shared with investors. Lastly, I'll take this one, and then Michael, there's a question on partnerships. But will you start floating the NAV, and how frequently will that adjust going forward? The short answer is yes, we will start floating it in the future. And Michael, if you want to answer in terms of the adjustment going forward, that'd be great.
Yeah, I'll answer that, Dave. Thanks. For 2 years, the NAV is set constant at $10, and then it will float after that. And we revalue the portfolio on a quarterly basis. So the equalizer for investors getting in is really that preferred return over the first 2 years. And the reason why we do that is because in the early stages of a development, there's not a tremendous markup that can be had. And it's really when the development gets closer to sort of being finished or halfway through that we start marking those up. There's a couple questions here. Krishna, please explain what you meant by 3/15 and 9/15. Those are dates, March 15th and September 15th. And those are the dates by which partnership gains can be invested. Partnership gains are really unique and nuanced, and there's a lot to know about those. They have multiple different dates. You can recognize those from I think it's the due date of the partnership tax return. I had to write that one down. There's so many different dates, or the end of the tax year. So right now, the rule is generally, if you had partnership gains in 2021, you have until September 15th to invest those gains in a QOZ fund and get the benefits. This next one is from Sydney. Sydney's asking about our different markets and our different funds that overlap within the same strategy, which is development. And Sydney, the litmus test is very simple. If it's a QOZ deal, it goes into the QOZ fund. If it's a market rate development deal, it is offered to our income plus fund first, and then it goes to our growth fund, but it goes in sort of a rotation, if you will. So right now, the income plus fund doesn't have room for another development deal. So all of the market rate development deals, which are deals that aren't in a QOZ zone, are going into growth fund 4.
Someone noted in the chat and then provided their contact info. They have an OZ site in Austin, would be interested. Absolutely. Love Austin and looking to scale up there. So I will reach back out to you or have my colleague in Dallas who covers that market for us. There was a question, Michael, on tax prep software that helps address OZ investments. I'm not aware of that, an answer to that. I would guess that if you have TurboTax or some of the other tax prep software providers, that there's an option there to select for forms 8949 and 8997. But we'll put the disclaimer on that. Please contact your accountant or your attorney for any tax specific questions in terms of your filing and preparation. And any other questions, Michael, that you're seeing in the chat box?
No, Dave, I'm working strictly from the Q&A box. And that was the reminder I said in the beginning to everybody. Please submit your questions in the Q&A. This message is from Uday. When will the preferred 7% return on investment for early investors show up in the account? So Uday, you have this is a capital account sort of profit sharing. It's a little bit more complex than that. So what happens in a distribution is we first satisfy the 7% preferred return to investors. So it really won't come into effect until we have a distribution, but that's something that we calculate on our side for waterfall terms and how profit splits happen. So you won't actually see your account growing by 7%. It's not a guaranteed interest rate as some people think about it. It's only comes into account once distributions start to happen, and that will all be detailed out.
Great. I just see 2 questions left. Is that right in the Q&A, Michael?
Yep, take one.
When do we receive tax docs for 2021? That'll be upon completion of our K1s. And Michael, I think we endeavored to have those on or about April. Is that right? I don't know if we can, we'll try and beat the tax deadlines if we can, but I guess what's been more typical in terms of our delivery of those K1s?
Yeah, we're shooting for April 1st, Dave. So just to investors, we're waiting for the K1s to come in from the property. Those all have to be rolled up. So there's a lot that goes into that. I can tell you, you'll receive communication from our IR department, but I would expect those right around April 1st. This message is from Julia, and it's about industrial being in high demand. Will the QOZ fund consider this or other investments? And Julia, the answer is no. We're not. This fund is going to be strictly multifamily. Now, by the very nature of some of these investments, we may have exposure to some commercial, because oftentimes when you build a multifamily, especially in an urban area like we're talking about in Nashville, the Edge Hill deal, there's a requirement to have commercial in the building. So, there's no way to really properly condo those out without damaging the overall nature of the building or that particular investment. So as a percentage of our overall NOI, commercial is going to be, I would say, less than 5% of the overall NOI in the portfolio. And Dave, there's I don't know if you're seeing this, there's a couple more questions coming in. So we'll give it another 2 minutes. What is the timing of the Nashville sidecar deal? We don't have that yet, but there definitely will be a sidecar in Nashville, and there will be one in Sawtell as well. Dave didn't get a chance to talk about that, but that is quite a large multi-phase opportunity in Atlanta. If you have an interest in those, again, these will only go out to fund investors. And in the last deal we had in Fund 1, that we had a sidecar opportunity in Colorado Springs, we had $15 million to syndicate. And we basically said, look, if the fund investors don't satisfy this, then we will come out to outside investors. And that wasn't the case. That we had, more than enough demand within our existing investor group within the fund, and we expect that to be here as well. So if you are an existing investor, you will absolutely see that. If you're not an existing investor and you want to see that, you have to come into the fund to be able to do so.
Yeah, Michael, I see one from Nisheth asking a question about partnership gain in 22, but won't know exactly what it is until they receive their K1 in April 23. Can I go ahead and take a best guess to invest this year in the remainder of next year after I get my K1, or do I need to wait until I get my K1? I believe the answer here is that you have to be able to demonstrate that the gain has been generated before you can qualify for an investment into the OZ fund. But Michael, you may know the answer to that a little bit better.
Yeah, that's right. And with the partnership gains, as long as you can accurately, and I would err on the side of being conservative. So if you think, for example, the gain is $300,000, you might only want to put $250,000 in if you're interested in investing today. So you can absolutely do that. Again, partnerships have all of these nuances. You can invest 180 days from recognizing the gain. You can invest 180 days from the end of the partnership tax year. You can invest 180 days from the due date of the partnership tax return. So there is a tremendous amount of flexibility in a partnership in the way that you can invest those into a QOZ fund.
Nola mentioned that we skipped my question. Sorry, Nola, I don't know. Let me see if I can pull that back up. And if I don't see it, if you could resubmit, we're happy to I don't see it here in the answered list. So if you can resubmit, we're happy to answer.
I have that, Dave. I'll take this, and then I think we'll be done. But Nola, you said you invested in December of last year, so you will be receiving a quarterly report most likely this week, and you absolutely have a portal account. You can do one of two things. You can either reach out to your investor relations contact, whoever that is, and ask them for your login and contact information, or I'm absolutely positive that it's been set up already. You can go to the website, go through the lost password protocol and find that. And you will see that in the portal itself. So, but I would, maybe reach out first and you can ask about that, but thank you for your question. Okay, well, that really, Dave, I think we're 10 minutes over, so that concludes it. If we haven't answered your question, you can always reach out to investorrelations@origininvestments.com. Ask your question there. We'll get that answered. Thank you for your time today. And if you have capital gains and you want to be in real estate, there's really no better place to be than in a QOZ fund. And I don't believe there's a better QOZ fund in the market than the Origin one, right? When you look at the pipeline and the team behind it, we have just an amazing opportunity in front of us. And again, if you are an existing investor, thank you for partnering with us. Really appreciate your time today. If you are somebody who's interested in partnering with us, you can either go to our website and connect with somebody there, or just email us at investorrelations@origininvestments.com. Thank you for your time.